Good afternoon and welcome to the Finsbury Food Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to John Duffy, CEO. Good afternoon, sir.
Thank you. Good afternoon, everybody, and thank you very much for attending and taking an interest in Finsbury. So I'm John Duffy, obviously. Steve Boyd is there, our Group FD. We'll take you through a presentation. I'll do a section, pass over to Steve, and then pick up again myself before the Q&A. So without further ado, though, and apologies to those that perhaps know the business a little bit better, I'll do a very quick self-introduction of the business. So one of the largest specialty bakery groups in the UK, we'll probably think of that as craft at scale. And just in terms of some of the attributes of the business that might be different from other groups that you've come across, we're pretty well diversified by product category, by channel, and also increasingly by geography across Europe. We operate in very large markets, so UK markets over £6 billion for bakery, so pretty substantial and therefore modest in terms of our share. We have a broad range of customers across those channels, and we deliver either ambient, in the case of grocery typically, or indeed frozen products in the case of the food service channel. We've got sort of diversified manufacturing capabilities for each of our product lines, and that tends to mean that our bakeries are product specialists. So unlike small bakeries, we don't tend to make all of the products in each of the bakeries. We make them in specialist areas. And then as well as doing a lot of what you might think of as premium on label, such as Tesco Finest type ranges and the like, we also have a strong brand portfolio where we effectively license brands, so the likes of Mars, Thorntons and Disney, and provide the innovation, the products, the sell-in and the customer relationship for those in store. So we're number one in a number of specialty categories, so things like celebration cakes for kids' birthdays and such, artisan breads and premium round cakes as well. So it gives you a little bit of a feel for what the group is made up of. So turning to the first half and the results that we're announcing this week, I'd say it was a very encouraging first half performance, but obviously it's despite the macroeconomic challenges, particularly cost inflation that we are facing into and dealing with at the moment. So group sales in the first half up just under 15 percentage points in value to £191 million in round numbers. Volumes broadly flat at group level. In individual channels and product areas, of course, we've got some going up, some going down, but overall broadly flat for the first half. And then looking at some of the specific areas in more detail, you can see that UK retail, so grocery, grew by just under 11%, primarily price. And then food service grew by some 22% year on year. And that's a mix of price and indeed volume as we bounce back from COVID. And then the overseas division has enjoyed really strong growth in recent years, continued to grow strongly in the first half, predominantly volume and a little bit of price, and up just over 23 percentage points. Steve will pick up the numbers later on in detail, but group EBITDA, 12 million, and profit before tax of 6 million, both marginally up on the prior year first half. And earnings per share diluted at 3.4p. Now, I will touch on this later, but we did manage to do a bolt-on acquisition just after the end of the first half, at the end of January, in fact. That was Lee's Foods, which is based up in Scotland and is a manufacturer of meringues, tea cakes and snowballs. So sweet snacking, I guess, would be a good description. And as I say, I'll give you a good bit more information on that later on. The dividend will be paid in 20th of April, and it's 0.87 pence, which is circa a third of the expected full year dividend. And I guess what we hope to demonstrate over the next 40 minutes or so is that whilst it's quite a tough environment at the moment, the business is doing all the right things, and we expect that once the economic situation and some of the backdrop eases a little bit, that we'll be very well positioned as a business. So without further ado then, I wanted to just talk to you a little bit about the markets that we're operating in at the moment, what we're seeing, how consumers and customers are interacting, and what's changing. So I've got a few slides to talk you through some of that. So firstly, this is a slide that those that followed us at the full year last year will probably remember. We've got an awful lot of macroeconomic challenges, and unusually all at once. So last year we were dealing with the fallout of the war in Ukraine, on top of the kind of supply chain challenges and dislocations globally, in fact, following COVID and the reopening of the world economy, and some local challenges as well around labour availability, drivers, etc. And all of that looked like a pretty difficult environment to perform and be challenged by. But in actual fact, I would say now we're kind of viewing it as business as usual, which seems amazing, but we are adaptable, I guess, as humans and indeed as a business. And I think we're just getting on with it and dealing with it. Some of it is settling down. So whilst labour rates and availability is still not easy, it's a lot more stable than it was, kind of probably 12, 18 months ago. Similarly with drivers and such. And even energy prices just recently are starting to come down off some fairly spectacular highs. So getting used to this environment, almost becoming business as usual, although I'm not sure that's something that we want to admit to. And then moving on to look at the really big, sort of driver at the moment of what the business is having to cope with and adjust to, inflation. So again, looking at this chart, you can see that we've gone from what you were used to, very low levels of inflation in recent years, and how that's changed quite dramatically over the course of the last 18 months or so. So this is CPIH, so effectively it's CPI including housing costs for owner-occupiers, probably the best relevant measure of the consumer that we are most interested in as a business. Running at about 9 to 10% in recent months. And you can see on the right-hand side there that in December, after housing, including energy costs, actually food and non-alcoholic beverages were the second largest contributor to that overall inflationary rate of about 9 or 10%. And indeed making up nearly 17% of that inflation coming from food and drink. I don't believe that that is finished. I do think that there's still some transfer of cost and inflation still moving through the supply chain, whether that's raw material supplier, whether it's manufacturer, whether it's retailer, ultimately on to consumer. And indeed we saw significantly high grocery input or price inflation in January, which gave us a good indication that that cost is still flowing through to the end consumer. And then looking at some of the grocery sector where we have a lot of very good data about shopping behaviours and changes and such. This looks at a number of attributes of the grocery sector. It looks at 12 weeks, the last 12 weeks of 2022, running up to Christmas, and it compares it to the same 12-week period the year before. So it gives a reasonably good indicator of what's happening. I guess what you can see is that post-COVID volumes had reduced within the grocery sector as the out-of-home sector had opened up again, but volumes were actually only down about 1.6%. Given that there's over 9% of price inflation, you can see that growth was actually in value terms for the grocery sector up over 7.6%. So some quite strong growth and a readjustment of volume versus the half year, also the full year when we looked at this similar data. A little bit more frequency of shopping, basket sizes still down a little bit, and most importantly, on label. We said that we thought it would enjoy faster structural growth during economic hard times. And at 13.3% growth, you can see that it is indeed benefiting as consumers fundamentally buy less, try to buy cheaper products, or indeed try to buy them in cheaper stores or channels such as the discounters as well. So you can see there's definitely some change in consumer behaviour, but I would also say that the grocery channel has actually improved its position since we looked at it last September. And in terms of the environment, the challenges, the inflation, it would be easy to think, well, difficult time to be in food. I tend to see things a little bit differently. So yes, there are a lot of challenges, but actually I think Finsbury is pretty well placed in many regards. And I sort of try to summarise that in sort of a few points here. Food is naturally defensive in truth, and we all have to eat, and we want to enjoy it most of the time, even in difficult times. And the bakery sector is actually relatively inexpensive per calorie, if you look at it like that. It's also a very good filler for all sorts of meal occasions during the course of the day. So it's a very, very versatile product area. Finsbury, I think, and we've even seen this in the half-year results and indeed last full-year results, we're quite well diversified. So whether particular channels such as grocery or food service are doing well or badly, or particular customers are doing well or badly, or geographies, we tend to have a foot in lots of different camps. So we're usually seeing the benefits in some areas, even if we're seeing the challenges in others. So diversification is a pretty important aspect of Finsbury's footprint. The own label growth that I talked about a minute ago, the majority of our sales are actually premium own label. So we are enjoying the tailwinds, I guess, of consumers buying more own label products as a group. And a lot of our products are sold into, areas such as education or sort of, I guess, fairly defensive sectors. And most of them are good value, affordable, everyday treats. So even kids' birthday parties, tend to still buy the licensed celebration cake of choice because it's quite an emotional purchase. And the business itself is well invested. We're an efficient scale competitor. We're one of the larger food businesses in the UK, probably the largest specialist own label provider in bakery in the UK. Got a strong balance sheet, and I think we are in good shape really to come through what undoubtedly is quite testing times. So just looking at some of our individual performances in subsectors. So I told you about the overall growth of the business, talked to you about some of the areas, grocery, food service, etc. This takes it down just another level to look at both bread and morning goods and cake in some of those markets. So if we look at retail bread and morning goods, obviously in recent years we've been selling more bread and morning goods in grocery and less in food service because of COVID. What we see here is the reverse. So we had much stronger growth in bread and morning goods in the food service channel, up nearly 30%. But in the retail channel, growth of 5%, which these are value numbers. And the market was actually growing a little bit ahead of that. So we're seeing some drive into sliced bread, which is all about value. So people looking for really, really good value in testing times. And of course, we don't tend to sell those types of products. We tend to sell more of the brioche burger buns and the more premium products like that, hot cross buns and the like. So reasonably happy with that growth, but we would like it to be higher. Very, very pleased with the food service, bread and morning goods growth. And then our retail cake growth, very strong, just under 12%, primarily price. Most of our product ranges are large cakes, so celebration cakes, premium round cakes. And the market actually growing a good bit slower than that, but the market is made up of about half of large cakes and the other half is snacking cakes, where we have a very small presence. And there, price inflation means lower promotional activity, means less volume, and some other changes to the market as well in terms of promotional locations under some of the changes on HFSS or high fat, sugar and salt legislation that came in during the first half. So again, strong performance in retail cake. Our food service cake business is quite small, quite modest, but you can see post-COVID bounced back really, really strongly with growth of just over 50% volume and value, which is great. And the overseas business, as I mentioned earlier, grew just over 22%. So yeah, I think a pretty robust performance. You can see, some quite big differences in individual product areas and individual channels, which I think is worth noting. And then in terms of the shape of the group, particularly for those that are less familiar with Finsbury, this kind of single chart tries to give you a really good feel for how the business is made up by category, channel and customer. So just starting on the left-hand side, you can see that our overseas business is now about 16% of the group. That was 14%, I think, when I presented last time. So the growth that we're seeing in Europe is certainly increasing that size of the pie. And you can see that just under half of the business is cake, and a good chunk of it is bread, and that's obviously the UK bakery portion, which is exploded in the middle pie chart here. So it's UK bakery, and you can see that key thing on this is that food service went down, I think, to about 15-16% during COVID, back up now at 22% of the group. You can see it's predominantly bread and morning goods within food service, with a little bit of coffee shop cake. And you can also see that within the retail business, a good 2/3 of that, in fact, is actually cake, and the remaining is our sort of specialty bread type product as well. And then very importantly, I often get asked about it on the right-hand side, in terms of the customers that we deal with. You can see that our UK bakery business, so everything other than the 16% overseas, we do business with most people. And so our largest customer, unsurprisingly, is the largest grocery business in the UK, which is Tesco. We also, perform very strongly with a number of other businesses such as the Co-op and Waitrose, who have, a real interest in specialty bakery, which of course, in terms of range, is exactly what we supply. So we tend to overtrade. And then some other areas such as the discounters in very strong growth, and indeed we do sell product to the discounters. But we don't sell very much of our range to the discounters because they have a very small range and tend to have much smaller stores. So there are only certain products that could justifiably get a shelf position in discounters. And then in the food service sector, we do business with, end users, but also with the large distributor food service companies and the wheels such as Brakes and Bidfood, as you can see there, both coming in around 4% or so. So a very well diversified business. That's an important aspect of our resilience, and it's something that we take into account when we look at acquisitions and investments in capacity. So I'm now going to hand you over to Steve, who's going to walk you through the P&L and the balance sheet and various other aspects of finance, and then she'll come back to you.
Thank you, John. So financial summary, Finsbury delivered, as John said right at the beginning, a very encouraging first half performance, despite ongoing pressures that we're facing. And clearly, the inflationary pressures is one of the biggest dynamics that we've had to account and handle during the course of the last 6 months. The revenue of the business is up 14.7% to £190.9 million. And that primarily is all about price recovery. There is a small volume decline across the group, but the majority of that growth is now the recovery of inflation. And the gross margin percentage is down 1.9% from 31.6 to 29.7%. And that quite simply is a consequence of the recovery of the inflation. So we are recovering all the inflation, but are focusing on the cash recovery of the inflation. From a perspective of the percentage margin, we haven't sought to recover more than we think was reasonable. And the real dynamic we're at play or at risk here is if we overdo it, then of course there may be a volume sensitivity. So at the moment, we're focusing on recovering the inflation, protecting the cash margins, but the consequence of it is that gross margins, and indeed, as you can see at the bottom on the left, their operating margins are down 0.5%. The operating profit, on the basis that we did recover all the cash inflation, is much the same as it was for the first half last year, slightly up at £6.5 million, is up 0.4%. Now, the first half of the year, the profit delivery is 6.5 million. If you look to the broker's note, we're expecting to deliver 18.3 million pounds for the full year. So that's a big step up from the first half delivery that we expect to deliver in the second half of the year. And this is no different actually in profile to what we delivered last year, and indeed we started to see it in the previous year. It is a dynamic of the recovery of inflation in the second half. Our price recovery tends to be higher than the inflation, and in the first half it's the other way around. And one would expect in due course, as inflation tapers off, and we're not talking about deflation because we expect inflation to continue in the foreseeable future into next year. But as it tapers off, one would hope that we'll see that profile split between the first half and the second half begin to reverse back to what we've experienced in the past. The full year gross margin, the full year operating profit margin, according, if you look to the broker's note, is going to be just shy of 5%, 4.8%. And that again is this dynamic of the first half versus second half recovery. Onto the right-hand side, and the EBITDA is again on a cash basis is 12.0 versus 11.9, so it's up 0.8%. The profit before tax down 5.1%, and that is simply as a result of the interest cost. There's an increased interest cost hitting the P&L of about 300,000, and that is a consequence of the slightly higher debt levels over the course of the year. But also, if you were with us at the year end, is a consequence of the renewal of the group's facilities. We renewed all the bank debt in June 2022, in June last year, and the interest cost of those, considering the changes that we were facing at the time, is higher. So that is what you're seeing coming through and pushing the PBT back to 5.7 million pounds. Earnings per share, as there's no change in the share base and the profit is much the same, is still 3.4p. And then the last point, this bank debt is over the course of a 6-month period, so it's comparing it to where it was at the end of June 2022, is up 2.2 million, and the reasons for that become very clear when we go through the cash flow slide. Before I move on from here, just a point worth making is, as you saw from the pie charts that John showed earlier on, the group very much 84% of the group is actually UK bakery, 16% of the group, a growing percentage. A few years ago it was sub 10, so it's 16% of the group is overseas. But on the basis that the UK bakery is 84% of it, the dynamics affecting the group are actually largely driven by the UK bakery. And that's important to remember on the next slide. So everything you see here is kind of repeated on the UK bakery side. So the growth in revenue, much 13.2%, is price-driven growth. The gross margin percentage decline 1.7% is the consequence of inflation recovery, the pound versus the percentage, and then that works its way for the exact same explanations all the way down to operating profit and operating margin percentage. On the right-hand side, the overseas business is, keep in mind that this is 16% of the group, and 90% of this is actually our distributor that we have in France, which we own 85% of. And that business has seen continued growth, substantial growth, both volume and value over the course of the current half year. And it is, as you can see from the figures there, £29.9 million, up 23.4%. The one thing that is unique about France is, unlike the UK, where when there's inflation coming through, manufacturers can simply go and recover it. In France, there is legislation that dictates that you can only recover inflation at one time of the year, which is exactly now. It's in February each year. And that is driven by, as I said, by French legislation. So we have been passing on inflation to our French distributor in the products in line with all the inflation recovery that we've incurred during the course of the year. And of course, they are only now able to renegotiate with the retailers those price increases. And then as a result, and as a direct consequence of that, you can see the gross margin decline going down from 20.6% to 18.2%, so a 2.3% decline. Operating margin profit going backwards as well because of this inflation, and operating margin reducing by 1.8% to 5.6%. So that inflation recovery is now. A year ago, when they were negotiating the prices, the level of inflation coming through was not as we expected. It has come through at a higher level, but we will see that position improve by the year end. Moving on to the cash flow, a very important slide. We're looking at the left-hand column, which is the half year to December 2023. The working down the EBITDA, 12 million pounds. The net working capital movement is adverse 4.6 million, and we kind of touched base on that before. This is primarily driven by stock. 4.5 million of that is increased stock. And John referred earlier on to business as usual. Inflation is business as usual for us now, but the fact that our costs are going up means the value of our stock holding is going up. So that's one factor involved in the increase in this figure. But the other factor affecting it is, in this uncertain world that is the business as usual comment, we have in certain areas taken up raw material stocks to make sure that we had continuity of supply, to make sure that we could continue to manufacture the product. So raw materials have gone up slightly, and similarly, finished goods in areas where we needed to hold higher levels of stock have also gone up. It's something that's been done on a managed basis. We know about it, we knew about it, and I expect that to continue as at year end. But after that, once we get more comfortable with the certainty of the supply chain and more comfortable with the demand profile, we'll edge that back down again. Moving down to the next line, CapEx. In 6 months, we've spent 3.6 million. Last 6 months, or the equivalent periods last year, we spent 1.9 million. This actually is actually the opposite of what we expect for the full year. So last year, we eventually spent 12.5 million, and again, John touched on this on an earlier slide. We have got new buns and rolls capability that's come into our Fletcher's factory, and that was a significant spend. It was over 6 million, and the majority of that was in the second half of last year. This year, we don't have an equivalent project like that on board, and therefore the 3.6 million in a half year is likely to be replicated, if not slightly higher, in the second half of the year, but will not get to anywhere near the 12.5 million that was spent this time last year. Lease payments are rentals on properties, so there's nothing new to talk about there. Interest, our weighted average cost of debt in the our effective interest rate in the first 6 months was about 2.2%. We will see that migrate higher as the new banking facilities and hedging agreements come through. I think eventually it will be about 4 to 4.4%, the effective cost of interest, and that should not go any higher from that level. Tax sees two opposite trends here. In France, tax rates have been reduced from what were a year or so ago, 33% down towards 25%. And here in the UK, the tax rates look to be increasing from 19 to 25%. So everything is converging on the 25% tax rate. So going forward, that is what you should be expecting to see as a tax cost, maybe slightly less with R&D recovery coming through, but the trend will be 25%, and that 1.4 million is the appropriate amount for the half year. But that leaves us with the free cash flow of 0.9 compared to the EBITDA of 12. I'll take you back to the comments that I made earlier on about the first half versus second half profit delivery. So the second half will see substantially more operating profit and EBITDA coming through compared to the first half, which will put the CapEx and the net working capital into perspective, and the free cash flow as a result of that at the full year will be much higher than you're seeing at the half year. Going on to dividends paid, that 2.1 million is the final dividend of last year paid in the first half of the year at 2.5 pence per share. And John's already told you that the new one will be 0.87 pence per share, which would likely be the first third of a 2.6 pence per share dividend. The shares purchased are shares that we put into the EBT. We take opportunity when the share price is unreasonably low to stock up the EBT. And then the final point really on this slide is that the final acquisition cost associated with the Ultrapharm acquisition in 2018 has now gone through, and there will be nothing further in the second half of the year or thereafter. And then the final slide from me is really to reinforce a point that John has made. We've got a very strong balance sheet, and that balance sheet supports ongoing investment and new growth, investment through CapEx, but growth through acquisitions. The debts is 22.8 million against the EBITDA, is a rolling 12-month EBITDA is 0.8 times, so there's a very healthy debt to EBITDA ratio. After the year end, we did do the acquisition of Lees, which John will cover in a slide, a couple of slides time. But that was a bolt-on acquisition that happened at the end of January. But the facilities we have are 120 million pounds, a 60 million core, and a 60 million accordion. It's largely, the accordion is untouched. We have enough firepower to do what we want to do on an ongoing basis, as well as to pursue our objective of delivering growth through acquisitions. On the right, just to again remind you that we have one small defined benefit pension scheme. This time last year, the balance sheets showed a 14.5 million IAS 19 deficit. But because discount rates have increased literally from 1.9 to 3.9, that has plummeted to 6.6 million. So it is a factor of the discount rate that's driving that reduction. The triennial actuarial valuation was due as at 31st of December 2021. It's in the process of being finalised, nothing untoward there. And in the context of that, we've increased our annual contributions to the pension scheme to 763. It was 500,000 before that. So the pension scheme has got deficit, has got smaller as a result of changing discount rates. And that's it from me, John.
Thanks very much, Steve. So just a couple of things then. I'd like to give a little bit of a quick update on strategy, including the Lees acquisition, and then a little bit on the outlook for the business as well. So just taking our strategy, so I gave quite a big update when we sort of last looked at these at the full year results. So I'm going to do a briefer update this time round. So 3 strategic pillars in the group. So excellence, growth, and responsibility. So just having a quick look at those. Clearly, in terms of excellence, the really big driver for us at the moment is our Operating Brilliance programme. So that's about being more efficient. It's about training people to continuously look at everything we do and try and find more efficient, less wasteful, lower cost ways of doing it. And our programme is delivering £3 to £4 million per annum of improvements in terms of our operating efficiency. And we expect to deliver that again this year and hopefully next. We did go live with a new HR system, in fact, we're about to go live, in fact, and that's going to give us, a much greater ability to, over 3,000 employees to look at training records, development, all of those sorts of things in a much more efficient way than we have done in the past. In terms of growth, Lees, which I'll touch on in a second, but also we've got some very good diversification showing, which I mentioned earlier. So we're seeing growth in different channels at different times, and that's actually very helpful for the group. And in terms of, short-term organic growth, we've got the new buns and rolls facility that Steve mentioned earlier, which should give us about another £10 million of sales capacity, which, we can get out there and begin to fill. And indeed, those conversations are ongoing with customers. We've got 1 or 2 things that have already been agreed. So, lots to go and lots happening within the growth pillar. And then in terms of responsibility, still a huge amount of work in terms of attracting employees, retaining employees, and developing employees. So a whole series of initiatives around that, as well as health and well-being, which is increasingly being recognised in this post-COVID world as being absolutely critical to having a good performing business. Moving to sustainability, which again, increasingly important to both the external world, but also to all of our employees, to feel that they're working for a business that's really focused on, doing its best for the planet. A couple of things really. We have now got a fully established and up and running sustainability forum within the group, which is led by an expert in that space who has been with us now for a good few months. We've got a number of sort of, good targets in place which are starting to deliver. So our energy usage is reduced by about 3%, and that's as a result of measuring in great detail all of the uses of energy throughout all of our bakeries and processes, and then trying to reduce that and optimize it. We're really focused on waste within our factories as well, so making sure that we reduce waste that can't be recycled, and we've managed to take down that waste that can't be recycled by 16% over the year, which is great. And we've signed up to the UK Plastics Pledge, which very logical, very sensible set of targets for 2025 in terms of all packaging being fully recyclable, and in fact all packaging including 30% recycled material. So again, one to work on with our customers who are just as focused on those types of improvements as we are. So lots happening in the various strategic pillars. And then moving to, I guess, a subset of that growth pillar, I'm delighted to say that we did complete the acquisition of Lee's Foods, a month or so, at the end of that January, rather, a few weeks ago. So it's a business that we've known for some time. We spoke to them a few years ago, kind of talked about valuations, and they were looking to have a retirement sale effectively. It wasn't the right time in terms of us agreeing on value, but we continued to stay in touch. And actually what we found is that the more we looked at the business and the more they looked at us, the more it seemed like, a good fit within the group. So they are a sweets, treats kind of category player. So very similar to some of our sweet cake and food to go and snacking type product ranges already within the group. So some good overlaps there. And they predominantly make meringues, tea cakes and snowballs. They have a good set of customers, but they have a very, very small sales resource. So one of the things that we can bring to the party as a bigger group is we've got a large commercial team, and we've also got a number of very good licensed brands, which we may be able to apply one or two of those brands to one or two of their products over the coming years. So really good opportunity for us to help accelerate their growth. Very high quality products, very good customer base, as I mentioned. And of course, one of the things in this environment that we want to be able to bring to the party are, sort of scale synergies. So the sorts of things to think about, I guess, are how do we utilize our larger management team in Scotland to manage this business as well. It's based less than 10 miles from one of our existing large sites in Hamilton. This business is based in Coatbridge, so that's very practical. We have obviously the opportunity to do joint buying, and we have the opportunity to do joint supply chain and logistics. And again, we have a very large warehouse not far from where their business is. We have similar customers that we were delivering product to. So I think there's some good opportunities to introduce some synergies or some efficiencies as we begin to develop a relationship within the business. We purchased it for 5.7 million, as Steve mentioned, from existing debt facilities. The run rate that we bought the business on was 21.6 million in sales and 0.9 million of EBITDA. And we would hope to move both of those forward over the next couple of years through a combination of growth and synergies. But earnings accretive in the current financial year. It's quite a seasonal business, so it is very big in the summer, particularly on meringues. And by next year, we'll hopefully have buried in some of those synergy opportunities as well. So delighted to have them as part of the group. I think they'll be a really good fit. I noticed that one of the questions later was about how quickly we were planning to integrate it. We've actually begun the integration program immediately. So given its proximity and its overlap with our existing cake business, then we've taken the opportunity to begin integration from day one. So that's already underway. And Steve and I witnessed that last week when we were up in Scotland ourselves. So just turning then to the outlook, we've got, I guess, a bit of a repeat of a slide, but brought to life a little bit more with what I've just been talking about. So first focus really is sales growth. So we've got a lot going on at the moment to grow the business. So clearly, our goal was strong organic growth. That is delivering at the moment in quite large terms through price inflation. But of course, what we're really more focused on over the longer term is volume growth. So inflation is really a bit of a flatter rather than sort of genuine underlying growth. Still got some great opportunities in some of the areas that we operate in. Yes, there are some headwinds as well, where some of our products, where consumers have got a bit less money, then clearly they are looking for great value. So we've got some great opportunities, some great challenges as well as part of that. But we're doing very well. We're competitive, and we've got lots of opportunities on the organic front, particularly with our new buns and rolls line, for example, coming in and giving us more capacity in an area that we've always been a little bit short of capacity. And then in terms of targeted acquisitions, we tended to have really a choice of two strategic fits. So either effectively doing market consolidation in a product area that we're already quite strong in, our core, or diversifying the business through new products, new categories, new customers, channels, or geography. And I guess recent acquisitions have all tended to fit into that second strategic opportunity. So in the case of Lee's, obviously, we've brought in some new product areas such as meringues and tea cakes, albeit existing customers and indeed existing geography as well. But we look at a lot of stuff, and we'll maybe pick this up in some of the Q&A later on. In recent years, the value of public companies of our sorts of scale versus private companies has had quite a big gap. So private companies have sold for much higher multiples than Finsbury's been rated on. So we've certainly found that disadvantageous in terms of completing M&A. It does look like the cost of debt and the availability of debt has peaked. And indeed, it's more difficult and more expensive. So it may well mean that as a trade buyer, with our kind of valuation metrics, that there are more opportunities going forward than there have been in recent years, which would be great. We're a disciplined buyer. We focus very much on what the value will be in our hands and what we can add to the business. And as you know, Steve's talked you through, we've got very strong banking facilities already in place, which were largely put in place before the difficulties that we saw with debt availability in the second half of last year. So rather fortuitous timing, you might say, but great to have those on board. So just in terms of the outlook then, our view is that it's going to continue to be quite a cost inflation environment. We're predicting sort of probably this year to be peak cost inflation. So I think we'd mentioned previously that last year we had about £27 million of cost inflation across the group to deal with. This year, that's probably going to be closer to 50 million. But we do expect this year to be the peak. And next year, we expect that to drop back down again. So we're still operating and we're still planning for that level of inflation. And we are very good now at dealing with it, very focused on both recovering costs from customers in a very genuine and open way, but also looking for efficiencies within the business and everything that we do, whether that's supply chain initiatives, whether that's overhead or our Operating Brilliance program. There's still strong demand for our products. So whilst consumers have less money, what we're seeing is that volumes of the group overall have held up. And that's great. That tells us that people really do want to buy our products. And we're good at dealing with adversity, is what we've discovered, and we're probably will emerge from all of this challenge as a more efficient and a stronger business, and that's what we've got to keep focused on. Most of our kind of product goals and the areas that we're developing and focusing on, whether it's free from, whether it's artisan, whether it's premiumization, those are all long-term consumer trends. And we think that means that the business is going to be, very much delivering and playing into those for the long term. And then finally, Steve talked you through quite a little bit of the pressures of, fast cost inflation and then having to actually recover those, particularly through price, given the scale. We did quite a lot of price rises in December. So that gives us a really good, confident outlook for the second half in that we know what the costs largely are, we know what the pricing largely is, and the only real variable then is consumer behaviour and volumes within the business. So we're on track, and we think that we are going to deliver market expectations for the year, and we think that the business is, holding up very well in probably the toughest environment that most of us have ever seen, a collection of challenges like no other post-COVID and all the rest. So that's the end of the formal presentation. So just hand back and take a minute before we move to the Q&A.
John, Steve, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. And John and Steve, if I could just ask you to read out those questions and give response to where it's appropriate to do so, I'll pick up from you both at the end.
Super, thank you. So the first sort of pre-submitted question we've got here, which I'll read out to you first, and then we'll kind of give an answer. So public filings have shown that a company describing itself as an active investor has recently built an approximately 13% stake in Finsbury Foods. In terms of the potential for strategic input, does Finsbury view this as a helpful development? I guess I would start by saying that as a public company, we kind of welcome any investor that believes in the strategy of the business and indeed the management team's desire to deliver that. So yes, DB bought a small stake, which they have progressively increased to just over, I think it's about 13.5% currently. A number of our investors over the years have described themselves as active investors, so that's not necessarily a word that has any strong kind of sort of foundation for us. Their engagement with the business has been good. They're really interested in the business and what the value creation opportunities are. They do think we're undervalued, which is a view that management share. And indeed, by acquiring a stake, I think they have helped improve the valuation perspective of Finsbury. So we continue to chat to a number of large shareholders who have over 10% shares in the business. Most of them have been long-term holders. We value their input, and we're very keen to discuss what we're trying to do and have a debate about the relative opportunities of different things to unlock value or improve the business performance. So we see it as a positive development. Second question there from Nick B is, when do you expect to fully integrate Lee's Foods into the group, and what attracted you to them in the first place? I guess I've already answered the first part in that we've taken a view that the right thing to do, particularly given it's a retirement sale, is to crack on and integrate it quickly. We think that's where we can add the most value, so that's what we're doing. In terms of what's attracted us to them in the first place, maybe ask Steve for his perspective on that, because it has been a few years.
Well, we had looked at them, as John said before, about in 2018. I would describe them as a shoulder industry. Meringues, pretty much, they have a line share of the market. They're a big player in that, but then also they do tea cakes, a chocolate-covered type of mallow. And those are the ones that we find particularly interesting. We think we can expand those further in with our licenses and just generally through our big representation in the retailers. So we think we can bring a lot to them over and above the points that John made with regards to the duplicated administration that we would have, and therefore we would have some ability to change there. But ultimately, we will leave it as a standalone company and let it continue to trade. So I think it's a revenue commercial drive primarily, but then there will be operational synergies that we can bring to that business, and it seems to us to be pretty easily deliverable. So that's what attracted us to it.
Thanks, Steve. Okay, next one was, how did you fix the labour shortages, e.g. the drivers? Did you offer higher salary or get drivers from overseas? I would say with all of the labour shortages, yes, we have effectively increased wage rates, whether that's for our own staff, agency staff, or indeed logistics providers, drivers. So yes, that's been one of the elements of cost inflation. We do anticipate, given, for example, that the national living wage is going up by just under 10 percentage points in April, and that's going to continue to be a theme. We've got record employment in the UK and have had now for a little while, and there is real competition for skilled labour and unskilled labour, in fact. So, yeah, we have effectively seen higher salaries, higher costs, higher wage rates to address the challenges of recruiting and retaining the labour that we need. Another question here from Nick B. Do you plan any further bolt-ons this year? What would you ideally like to add? I guess it's always difficult with timing. I think there's no doubt a number of smaller businesses are finding the current environment, quite challenging on top of dealing with COVID and Brexit and all of the other things that we've had in recent years. I think a number would ideally like to find a home for their business that would be a good owner in the future. But I think valuation is still a difficult point. I think recent valuations were quite high, and I think there's a gap still between private company valuations and public company valuations, such as our own. Ours being lower on public markets, and I think therefore there's still a little bit of time to play out. So I think there will be some, whether it's this year or whether it's next year. I wouldn't like to comment. I think it's largely going to be determined by valuation expectations being met or not. Next question here from Nick S is, what overseas countries are you in, and what are the growth prospects in each? Now that's quite a big question. So maybe ask Steve to just give his perspective on the markets that we've the near markets in Europe that we are in or have thought about.
Yeah, so the overseas business, as I said to you, 90% of that overseas business is our French distributor, and I would have thought 90% of that is actually in France. Where we are seeing growth is in the satellite countries to that. So in Benelux, Belgium, and Holland, we're gaining traction there. Again, in cake style products from the UK. And also we're beginning to see real traction in and around the Polish factory, the gluten-free factory, where when we bought the business, they had no customers in that area. And now we have a strong presence in Poland and increasingly in the neighboring territories to Poland. So we're seeing, but as we said, the primary focus is France. Addition to that, small representation in Scandinavia, which is still growing. But that will be it. So those are the major countries where we deal in Europe, in near Europe.
Thanks, Steve. And then I think maybe the last question here that we've got at the moment from Richard E. With CapEx reducing, can we expect better than inflation increases in dividends? That's a question I'm familiar with. I do get that question from a number of shareholders quite regularly. I guess that is one option, would be my comment. So what we're trying to do with the group is grow it. We're trying to grow it obviously organically, but also through acquisition. So we want to be in a position, if the right opportunity arises, to be able to progress with acquisitions. So what we tend to do is try and pay a reasonable dividend, but also to pay down debt. And by paying down debt, of course, it reduces our short-term interest costs and such, but it also gets our debt to EBITDA level back lower again. And so that if another growth opportunity comes along, a small one or indeed a big one, that we've got headroom both in terms of the debt that's available there. So I think it's always a balance. I think the other area that I think is of great interest to us at the moment is automation. So in recent years, we've invested quite well in our systems to become more efficient, to allow us to have great data to improve what we do. But there's no doubt that the cost of labour now is quite significantly higher than we anticipated a couple of years ago. And there's still quite a lot of automation opportunities, both big set piece autopilotization type projects at the end of a line, or small cobots, which do small repetitive tasks that individuals can do, but frankly aren't very value added. So we've got some big opportunities already identified for more automation capex. They have very good paybacks at sort of, 2 to 3 years, quite a few of them nearer 2 years. So I think we've got some quite good choices in front of us in terms of dividend, investment in automation, paying down debt and freeing ourselves up to do more acquisitions in hopefully a market that's moving towards us. So I think that's one option. I think ultimately the board will try and weigh up all of the alternative uses for free cash flow and try and make the right balance so that we add as much value as we can for shareholders in totality.
John, Steve, thank you very much. I think you've addressed all those questions from investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, John, could I just ask you for a few closing comments?
Yes, certainly. So firstly, thank you very much for giving Steve and I the time to give our perspective on the business and try and talk you through how we see the current environment and the choices we're making. So, we really appreciate that, and we hope that we've given you a good insight into what is a very fast changing business, but particularly market and environment that we're dealing with. So I think what I would say is that, a year or two ago, I think if we had said to you, these are all the things that we're going to be faced with and we're going to deal with, I think you rightly would think, oh, that's quite a difficult backdrop. Who would want to be in food? Who'd want to do that? I hope that we've shown you that actually these costs, these challenges are the same for everybody. So it's not that, we have to deal with them on our own. All of our competitors, all of our customers are dealing with them. And so actually what we think it comes down to is how well we handle them, how well we respond to them, how well we think them through and get ahead of them. And I think what we've demonstrated, again in the first half and through the course of last year, is that yes, we can deal with them. We're a very resilient business. We're well invested. We've got really strong, very good and extensive management teams. And I think we'll continue to deliver strong organic growth. And we'll continue to invest in the business and try and make it a really strong platform to unlock what we think is the acquisition growth that could well be ahead of us. So challenging times, but I think the business has stepped up, and I think the resilience and the, effectively 30 million of EBITDA that we've been generating over the last few years consistently through thick and thin, whether it's COVID or whether inflation, I think should give you quite a lot of reassurance that food and bakery and Finsbury is quite a good place to be in the current challenging environment. So thank you again.
Thank you.
John, Steve, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Finsbury Food Group PLC, we'd like to thank you for attending today's presentation, and good evening to you all.